All right, let's get going. My name is Erwin Kratz. I'm an ERISA attorney at ERISA Benefits Law. Not surprisingly, I focus my practice on all things related to employee benefits and ERISA. And thank you for joining us for this webinar today, Guide to Employer Tax Credits under the Family's First Coronavirus Response Act. A couple of housekeeping things. First of all, this is a general summary of the law. It is not intended to be specific individual legal advice to any employer, because each employer's circumstance is slightly different and you each have some nuances that might impact how you approach the general issues that are discussed here. Second thing is, you're all on mute, and I would appreciate if you hold your questions until the end, type your questions in at the end, and then I'll be able to get to all of them once we finish the main part of the presentation. So with that, let's move on. The first thing we're going to do is I'm going to go through a little bit of a summary, quick summary of the law and the leave that you have to require, just as background to make sure that that's fresh in your mind. And then we'll talk about the tax credits and the various components of the tax credits, how to calculate them, and what documentation you need to support your claim of the tax credits, as well as some implications of these tax credits on other recent legislation that impacts business ability to get tax credits, as well as forgivable loans with relationship to COVID-19. So starting with the summary of the law, both of the Emergency Paid Sick Leave and the Emergency FEMLA Act take effect on April 1, 2020, and will sunset on December 31st, 2020. And that's slightly different than what we thought a week ago. Initially, the IRS said you could start taking tax credits as of March 20th. Then they changed their mind, and now you can only take tax credits for paid leave that was taken on or after April 1st. And so it doesn't matter when the leave is actually paid, but the leave had to be taken on or after April 1st and before December 31st. So for example, somebody gets paid today for leave that they took on March 30th, that's not subject to the credit. But by the same token, if you pay somebody in the first week of January for leave that was taken during the last week of December, that will be subject to the credit. Emergency paid sick time, reasons you can take the leave. There are essentially two kinds. I think it's helpful to think about this leave in two kinds of categories. Number one is the very personal reasons for the leave, and that's the three that are listed on the screen. It's because the employee is subject to a quarantine or an isolation order, or the employee has been advised by a healthcare provider themselves to self-quarantine, or they're experiencing symptoms of COVID-19 and they're seeking a medical diagnosis. So those first three reasons for qualifying sick time leave are all basically personal. The individual is suspected to, or in fact does have, a diagnosis of COVID-19. Then the last two reasons for the paid sick time are what I think about as the caring reasons. Number four is the employee is caring for somebody, one of those people listed above, who's in quarantine or has been isolated either by a government order or by a healthcare provider advising them to isolate because they have a diagnosis. And then the fifth one is probably the most significant one, or hopefully it's the most significant one for most of you, and that is that the employee is caring for a son or daughter if the school or place of care of the son or daughter or a child care facility or provider is unavailable due to COVID-19 precautions. I think that will most likely be the most applicable qualifying reason for leave for most employers. And that last reason is the only reason you can go beyond the first 2 weeks of paid sick time and get into the FEMLA leave, the emergency FEMLA paid leave. It is the same requirement, the same qualifying reason, the child or daughter being out of school or out of a child care provider, and a parent having to, or somebody having to take care of the parent having to take care of the child. There is a new requirement that we just got about, I can't remember exactly, maybe 4 or 5 days ago now. And it comes out of the IRS Q&As where they talk about the documentation which you need to support a leave for care of this kind. And that is if a parent is caring for a child who is over the age of 14 during daylight hours, that doesn't qualify for the tax credit unless, and this is a quote directly from the IRS Q&A, special circumstances exist requiring the employee to provide care. They haven't given us any specifics about what that means. And so I think it'll be, until we get more specifics, it will be I think it's fair to interpret it broadly. You need to have your employee tell you if their need to care for somebody is a need to care for somebody over the age of 14 during daylight hours, then they need to tell you that special circumstances exist requiring them to provide the care. And I think the theory there is that most children over the age of 14 during daylight hours don't need somebody supervising them to care for them, but there may be special needs children or other circumstances which aren't specified that might require that. How much leave do you get? How much leave do employees get? Full-time employees get 80 hours of paid sick time, which is effectively 2 weeks at full-time, 8 hours a day. And part-time employees get it prorated. We're not going to go into great detail here about how you prorate. The prior webinar discussed that. How much leave do you get for family leave, emergency family leave? It's 10 weeks and starts running. Those 10 weeks of paid leave start running after the first 2 weeks of the paid sick time run out. So it's really a continuous period of 12 weeks total for those people who need to stay home for caring for their children. And by that, I don't mean it's not intermittent, which we'll talk about, but it's 12 weeks of leave between family and paid sick time. The other aspect of the emergency family leave that you might not spot at first glance is that it counts against the regular family leave entitlement. So if you have an employee who's already exhausted their family leave before this whole COVID situation came up, and as of the date they're asking for this leave, they have no family leave entitlement left, then they can't get this extended 10-week period after the first 2 weeks of sick time. Talking about when you can take these kinds of leave intermittently, this is some guidance we've received as well in the last week or so. Paid sick time, which is any of those six reasons, can only be taken if it's being taken by, it can only be taken intermittently if it's being taken by somebody who's teleworking. And if an employee is not teleworking, in other words, if they have to come into the office, then you can only take sick time for reasons of caring for a child or who's out of school or out of childcare. You can only do it intermittently for that reason. The policy reason is pretty obvious. If somebody is in fact diagnosed with COVID-19, obviously they can't be coming into the office and then staying at home to take care of themselves because they're sick the other rest of the time. We don't want them in the office spreading the disease around. And by the same token, if they're caring for somebody who is in isolation because of COVID-19, we also don't want them coming into the office because there's a risk, the risk is elevated that they would infect other people. And that risk is much, much less significant with somebody who's caring for a child who's off school, because the theory isn't that the child is infected with COVID-19. How is paid leave compensated? The base you use for your compensation is the regular rate of pay under the Fair Labor Standards Act. So you use your Fair Labor Standards Act rules for determining what somebody's regular rate of pay is. And then you're either paying them 100% or 2/3 of that amount multiplied by the number of hours that they would otherwise be normally scheduled to work, but for the paid sick time or paid family leave. So it's the differential, it's the loss of hours that are caused by the qualifying reason that are compensated, and it's compensated at either 100% or 2/3 of their regular rate, subject to some other maximums. So the 100% rate applies to those first three personal rates of reasons for leave. I'm sick, I'm quarantined, or I'm in isolation because somebody, a healthcare provider, put me in isolation. Then you get that person gets 100% of their regular pay. and up to a maximum of $500 a day or $5,110 in the aggregate, which is 10 times that amount for the 10 days of leave. And for all the other sick time, for the caring sick time leaves, it's 2/3 of the employee's regular rate, subject to a maximum of $200 a day, and then the aggregates are 10 days times that, or $2,000 for the sick leave, or 50 times that for 50 days of family leave, for $10,000 for the family leave. The concept seems to be that if you're personally sick, you just get paid more. And if you're caring for somebody else, that's not valued as much. Whether that's a good or bad decision, that seems to be the policy there. The taxation of the pay that you make, according to the Act, it's not subject to the employer's share of Social Security tax. So you do not have to transmit that. It's not calculated. It's not added. It's not due from the employer. But it is subject to the employer's share of Medicare tax. And we'll talk a little bit about that, because then you also get a credit for that Medicare tax. But you have to pay it, or you have to report it as due, and then you get a credit for that same amount at the same time. And then it's also subject to the employee, so all of the employee income tax withholding, Social Security, and Medicare. So the employee does not get a tax holiday on this pay. Let's take a couple of examples that illustrate these rules. Imagine a full-time employee who's paid at a rate of $30 an hour, and they could work full-time at home, teleworking in other words, except that their child is off school due to a school closure. So they can only work half-time, 20 hours a week, and they're doing it by teleworking. The employer will pay this employee full-time wages, full wages, $30 for those 20 hours that they work. And then they'll pay them the sick time or family leave hours at $20 an hour, because that's 2/3 of 30. And the employee would use 2.5 days of paid sick time per week. So they're taking their family leave or sick time leave intermittently with working. And each week they only get charged with 2.5 hours because it's half time. And the employer could, if they wanted to, but are not required to supplement that 1/3 of pay for the sick time. But they can't obviously take the credit because that is in excess of what the Act requires. So an employee in this situation could take a month or 4 weeks to get through their 10 days of paid sick time. Example number 2, this illustrates another aspect of the way you pay. It's the maximums. So same employee, let's say their rate of pay is $50 an hour, and same situation, they can work half-time, and they're off the other half to care for the children. $50, they get paid $50 an hour for the 20 hours a week they work, and then the employer pays the other 20 hours at $25 an hour. And the way you calculate that is it's 2/3 of 50 would be $33.34 an hour. So that's the starting point. Do we pay them $33.34? No, that's too much, because that works out to be more than $200 a day, and 8 hours is the day, and that exceeds the 200 max. So if we take the 200 max for the day, it really works out to be $25 an hour. That's how I interpret it. I don't think the right way to do this would be, let's say you had a part-time employee, and in each day they only work 4 hours. I don't think they get a $200 max for that day if they're taking off that one day, because it doesn't really count as a full day of paid of leave for a full-time employee. But I could be wrong on that. It's possible. There is an interpretation that says if you have a part-time employee, effectively the hourly max they get would be higher, because in each day they're not going to hit that $200 max unless their rate of pay is over $50 an hour for somebody who's working only 4 hours a day in a regular schedule. So I think the way it's illustrated here is correct, but that's my implication from all the rules I've read. And the same employee would use their 2.5 days, and the employer could supplement if they wanted to. So once you've done all that, you've paid your employees, how do you get your credit? What's your credit worth? Your credit is up to 10 days of the qualified sick leave wages, and we'll talk about that. That's a defined term, plus up to 10 weeks of the qualified family leave wages, plus any qualified health plan expenses that are allocable to those wages. So there's a defined term there, qualified health plan expenses. We will spend a fair amount of time on that. And then we'll also spend some time on how you allocate it to the hours, to the wages. And the employer's credit is also the employer's share of the Medicare taxes imposed on those wages. So this comes back to what I was talking about before. There is no employer Social Security share assessed on these wages, but the Medicare tax is assessed, the employer's Medicare tax is assessed, and it's credited. And you get to take the credit, which is all of the above, against all of the payroll taxes, Medicare, Social Security, and income tax payments that the employer would otherwise have to pay on that pay period, whether it's for people who are getting paid the sick leave or people who are just getting paid regular wages. You get to take that credit against all of the taxes, payroll taxes you would otherwise be submitting. And if that's not enough to satisfy the credit on that payroll period, you can get a refundable. You can get the excess refunded, and we'll talk about ways to do that in a minute. So, what are qualified sick leave wages and what are qualified family leave wages? Those are wages that are not to FICA taxes, paid pursuant to that, up to those maximums amount. The maximum amounts 200 or 500 a day, and subject to the maximums of 10 times that or 50 times that for the family leave. So the wages are pretty straightforward. I don't think that once you figure that out, what you have to pay somebody, that piece of your tax credit calculation is relatively, it's done already. The more complicated part is the qualified health plan expenses, which you get credit for. Those are amounts that are paid or incurred by the employer to provide and maintain a group health plan. And the Act says it's as defined in Section 5000B1 of the Code, which is the group plan requirements for under the Code, to the extent that they're excluded from an employee's gross income. So interestingly, the credit for the employer includes both the employer's share and the employee's share of premiums, if the employee's share was paid with pre-tax money, which mostly it would be going through a cafeteria plan. So ironically, the less generous the employer is with its contribution towards the cost of employee coverage, the bigger its credit is. It effectively, well, the credit stays the same, but it effectively gets credit for payments that were really coming out of the employee's pocket. And the credit is only for the qualified health plans expenses that are allocable to the leave wages. So let's talk a little bit more about how we determine what these qualified health plan expenses are before we get to allocating them. If you have different plans, like a group health plan versus a flexible spending account, or different plans that cover different groups of employees, you might have one insurance policy that covers people in one state and a different policy that covers people in a different state, or you might have union versus non-union. But if you have separate plans, and by this, I would go by the plans, how they file their Form 5500. If they're a group health plan with more than 100, and they do file a 5500, I would go by that plan number 501, 502, etc. So you determine it separately for each plan. Now, what is a group health plan? If you have dental and vision that are integrated with your medical plan, in other words, when you sign up for the medical, it's one decision, and dental and vision come along for the ride in that plan, then that is all one, and that's definitely included. If you have separate dental and vision, so you can people can enroll separately in dental and or vision with or without going into the medical plan, then to the extent that those dental and vision plans cover medical services, then they are a group health plan. So things like most dental plans probably would be if they cover things like dental surgery, and most vision plans probably would not be a group health plan if they just provide eye vision and glasses and adjustment. Group health plans include health reimbursement arrangements and health flexible spending accounts, and there are rules for how you do those calculations, which I'm not getting into here, but they're in the Q&A, and we may well get more guidance later on. This is going to focus on the medical plan. And the other thing is it does not include contributions that the employer makes to health savings accounts, Archer medical savings accounts, or qualified small employer health reimbursement arrangements. So the employer can use any reasonable method. Now we're going to talk about allocating those health plan expenses to the hours that you pay for sick leave and family leave. You can use, this is the overriding rule, you can use any reasonable method to determine and allocate the plan expenses. And the examples that the IRS gives is that one of the things that you can use is the COBRA applicable premium for the employee typically available. And that applies to both self-insured and insured plans. So either one can use the COBRA rate. And that's the one I think, well, I know in my mind, that's by far the simplest one to start with, because it's done, step one is done already. We know what your applicable COBRA premium rate is for various levels of coverage. But there's an alternative way you can do it. If you are a self-insured plan, you could also use a reasonable actuarial method to determine estimated annual expenses for the plan. I would say if you've already had that actuarial calculation done and it's a reasonable method to estimate what your actual expenses will be for the plan for this year, then you might consider using that. It might give you a higher number, it might give you a lower number, but take a look at that. And if you're an insured plan, you're also allowed to use an average premium rate for all employees. So you're allowed to effectively average out the premium rate over all of your employees, which might be advantageous if, for example, you have a few employees taking this kind of leave and they all have family coverage. Then you probably want to go with the COBRA rate because you're going to pick those high people, you're going to get the high costs, and they're not going to be offset by some of the people who have self-only coverage. Or if it's the other way around, you might want to use the average premium rate if the people who take this leave tend to have self-only coverage or less expensive coverage. And you can also use a substantially similar method that takes into account the average premium rate determined separately for employers with self-only and other than self-only. So you can do it on a whole rate plan basis where you just look at all the coverages and take the average, or you can say we're going to divide it into two. We're going to say our self-only average rate is this and our other than self-only average rate is this, and then you take which of those two buckets your employee falls into, and that would be your starting point for determining their health plan expenses. So the statute says, and the guidance corresponds with this, that the allocation can be made pro rata among covered employees. That's the total cost divided by each covered employee, and pro rata on the basis of the periods of coverage relative to the time periods of leave to which such wages relate. So I think what this means for an insured plan, that if you want to do something other than the COBRA rate, you could go and look at it on a monthly basis and say, what was our total cost for the month? How much did we pay the insurance company? And divide that by the number of employees covered in that month, and that will give you step one, the per employee cost for the month. That's worth doing if you're an insured plan. Compare that to your COBRA rates for, let's say you have one person who's taking this leave. You might compare the two and see which one gives you the higher number and do that. I do recommend though, whatever method you choose, don't switch from one month to the next. Pick a method and go with it, because otherwise it's just, you're being too cheeky. Then, once you've got that per employee cost for coverage for the month, either the COBRA rate or the average monthly rate, then you allocate that dollar amount to the days or hours of work plus the paid sick leave time. So all the pay you paid to this person, how many hours did we pay them total between worked hours and non-work hours like vacation or paid sick time, whatever hours we paid them for that particular employee, and then multiply that number. So that first step gets you the dollars per hour, and then multiply that by the hours paid for the actual sick leave or family leave to that particular employee. So the way I think this works is in this example that comes here. Let's just take an example of, say you've got 100 employees covered by the plan in this month, and your total premiums are $10,000 for the month, $10,000 for the month. That works out to be $1,000 per employee. So if your employee takes 50% intermittent leave for the whole month, then it's $500 in qualified health expenses that month. Now, obviously, it's not going to work out. That last step often won't work out so cleanly as the example here. And the other parts, well, the numbers can change, but the math will work out if you do it properly. So that's how I think is the right way to do it on a monthly basis. If you look at the IRS Q&As, you'll see some discussion of this average premium rate concept. And I think they do it in a way that is really, really confusing. So it gives me a little bit of pause, but not much, because of that overriding consideration that it needs to be a reasonable method. And I think there's all kinds of holes in the way that IRS Q&As discuss this concept, because they talk about it in terms of an annual premium. And so they tell you to take the annual premium for all employees covered by the policy. Well, how the heck do we know what our annual premium is going to be for 2020 when we're sitting here in April? We don't. So we also don't know how many people are going to be covered. So I think what it means is you can do it on a monthly basis. I don't know why they use an annual basis. I suspect it's because everything is being done so quickly. And I wouldn't be surprised if we get actual regulations that say something more precise and give some examples about months. So the IRS says that once you've got that average annual premium per employee, then you divide it by the number of hours worked during the year. Again, we don't know how many hours somebody worked during this year. Are we making assumptions, or how are we doing that? It doesn't seem to make sense. So I'm not going to go too much further into the IRS Q&A on an annual basis. I'm going to keep going with that monthly premium concept and the COBRA rate. And we're going to talk now a little bit about how we take, once we get that monthly rate, whether it's the COBRA monthly rate or the average premium rate that we're using for the month, or the annual actuarial cost for a self-insured plan divided by 12 would give us a month. How do we then break that down to the days and hours that somebody's taking as leave? So let's assume an employee is on paid leave and they have self-only coverage in the COBRA rate, or we could also assume the average premium rate that we determined using one of the other methods is $800 per month. The full-time employee takes 40 hours of paid leave in the first 2-week pay period of April, and that's 5 days of leave over 10 total working days. And then you look at a calendar and say, well, okay, we paid them for 10 working days in April. How many working days does April have? And it turns out, if you're just a Monday through Friday employee, it has 22 work days. So I think what you do in that case is you've got the 5 days we've paid them divided by the 22 days, work days in the year, in the month, sorry. That's 22.72% of the total monthly average premium for this employee is allocable to the 5 days of paid leave we paid them in the first 2 weeks of April. And that gives us $181.81 in qualified health plan expenses. I think that is the most reasonable way to do this because you'll do your calculations once each pay period. You'll just take, what is my average rate this month? How many work days this month total? Divide that out, and then multiply by the number of work days, a number of days total that you paid in paid sick leave. So that's about the allocations of the health expenses, health plan expenses. How do you take your credit once you've calculated what it is? First thing you do is you reduce the amount of tax that you transmit with each payroll to the extent possible. So you look at what your credit is and you just take that off what you would otherwise have to pay. If your credit exceeds the payment obligation, then you have a choice. You can, but you're not required to but you can request an advance of the credits by completing Form 7200. The link here is to the IRS website that has another link to the form as well as to the instructions. It's a surprisingly easy form to complete. It's like a one-pager, and once you've done those calculations that we just talked about, it's pretty straightforward. You can fax in the return, and then the IRS says, I think they said within 2 weeks you'll get your money. That I would only do that if the cash flow issue is significant. Otherwise, I think you're creating a lot of moving pieces, or more moving pieces. If it's not a lot of money, or if you anticipate, you could just take the credit against the next payroll. You could carry the credit forward basically to the next payroll and just not pay as much on your next payroll in tax, if that seems like it would work out. But if you're running big deficits and it's just going to become cumulative, then consider submitting that form. There is no limit on the number of times you can submit the Form 7200. Well, I suppose you shouldn't be submitting it more than one pay period, but you can submit it more than each pay period. You could submit it every pay period during the quarter, or you could decide not to submit it, and then you square it all up on the 941. So they're going to need to give some revisions to the 941 to account for the credits that people have the accelerated credits you've previously applied for, if any, and then to refund any excess still due back to you at the end when you file your 941, your quarterly Form 941. Self-employed owners also are able to get this credit. It's going to be claimed on their individual income tax return. I'm not going to go into that here because this is focused on employers with employees, not self-employed people. But just that's something to look for if it applies to you or somebody you know. So how do you document your claim to the tax credit? To support your credit, you're going to have to receive a written request for leave from the employee, in which the employee provides their name, date of birth, dates that they want to take the requested leave, and a statement of the reason for the leave, one of the qualifying reasons, and a statement that they're unable to work, including by means of telework for that reason. So one of the questions I got is, can we do this online? Is that a written request? Well, I don't know, but I think I would apply a rule of reason to this. If you're getting a document or an online form where somebody is doing substantially the same thing as taking a piece of paper and marking check boxes, to me that ought to be exactly the same. The question is, do they need to sign it? I think it's better to have something signed from an employee, but you can get things signed online. You can get e-signatures on things. And I think further than that, if they're using an employer-provided email address, then you have some reasonable expectation that when you get an email from that address and it's been completed, when you send an email to that address telling them where to go to complete a leave request, and then you get a completed leave request from somebody who says their name is whatever your employee's name is, I think that's a reasonable, in most cases, that's going to be a reasonable thing to assume that you actually got it from your employee. So take some steps to ensure that they do something affirmative to say, I am making these representations by submitting this form, something along those lines, to give it some credibility. So in addition to those requirements, which are pretty, let's just go back, the employee's name, the reason for the leave, and making a statement that I'm unable to work and I need to take the leave. These are not onerous requirements. It's pretty conducive to giving the leave, which is the purpose of the statute. So in addition, if the leave is based on a quarantine order or a self-quarantine advice, so this is the personal reasons for leave where somebody it's the first two personal reasons for leave. If somebody is quarantined or in or in isolation due to a healthcare provider telling them to do that, then they also need to give the name of the entity, of the governmental entity that ordered the quarantine, or the name of the healthcare professional that advised them to quarantine. And if the person subject to the quarantine or advised to self-quarantine is not the employee, so this would be the fourth reason where you're caring for somebody who's under a quarantine order, you have to give that person's name and their relation to the employee. So very interesting. The Department of Labor says you are not allowed to ask for more than this listed, everything we're going to list here. You're not allowed to ask for more than that, except to the extent you need it to support a tax credit. The IRS says you can ask for all these things, plus you can ask for, there was one other item, and I think we'll get to it, but the bottom line of it is that everything that I'm listing here is what you are required to get for tax credits and under the current guidance, and you are not allowed to ask for more than this, according to the Department of Labor. So, for example, if you have a request for leave due to isolation on the advice of a healthcare professional, you can't ask for a letter from that healthcare professional. You can only ask for their name. What can you do with that? Can you call the healthcare professional? I don't think so. And I don't think you should, because all you're getting is the documentation to support paying somebody and then giving them the leave. Now, there may be some circumstance that comes up where you suspect somebody is abusing this, and that will create some really interesting questions, whether you can go further, whether there are circumstances where you can inquire further, because on its face, what you're getting is close to nonsense. I don't know the answer to that question, and if it comes up, we'll need to talk about it in an individual case. But short of that kind of suspicion of abuse, the statute really is designed, the act is designed to facilitate easily approving and giving this leave. The other thing is that the IRS, I think actually it's this person, the IRS added the requirement about the relation to the employee. It doesn't say whether they have to be related to you in any way. So, you know, my relation to, the relation of this person to me is they're my friend. That should be enough. You can't, so the person has to tell you what the relation is, but apparently it doesn't matter what they say. So if leave is based on school closing or childcare provider unavailability, and this is the one that's most likely going to apply, then the employee statement must also include the name and age of the child or the children to be cared for, the name of the school that is closed, and a representation that no other person will be providing care for the child during the period for which the employee is receiving family and medical leave. And with respect to the employee's inability to work or telework because of a need to provide care for a child older than 14 during daylight hours, a statement that special circumstances exist requiring the employee to provide the care. I apologize. This last one is the one that the IRS added. So I think you can ask them to tell you what the special circumstances are, but I don't think, unless you get absolute nonsense, like the special circumstances are, I feel like staring into space or some ridiculous thing, I don't think you would be denying the request for leave based on what the answer is. And again, you can ask for the name of the school. You can ask for any documentation from the school that they have in fact closed. Neither department, this makes the point I just made that you're not allowed to ask for anything more when an employee requests leave due to experiencing symptoms. I'm sorry, neither of them address the circumstance at all where somebody is asking for leave due to experiencing COVID-19 symptoms. So in that case, all you can ask them for is their name, the stuff that you can ask, that you need to ask everybody for, which is their name, the dates they want to take the leave, a statement of the reason for the leave, and a statement that they're unable to work. So you're not allowed to ask for the name of the healthcare provider they're consulting to get their diagnosis. You're not allowed to ask them for a note that shows the results of they're seeking diagnosis. So this creates a potential problem. If somebody says, I want leave for a week because I'm experiencing symptoms and I'm seeking a medical diagnosis. Can you say a week's too long? I don't think so. But at some point, if they said, I want 3 weeks, I want 5 weeks, because I'm experiencing symptoms and I'm seeking a medical diagnosis, and I'm still seeking a medical diagnosis 5 weeks later, at some point, it has to become absurd, but I don't know what that point is, because the proposed regulations don't tell us that. They tell us clearly that you're not allowed to ask anything more. And they don't list any requirements, anything that you're allowed to ask in these cases. So there is a potential hole. The additional documentation that you must maintain. So in addition to everything that we just talked about in terms of what the employee needs to give you for their leave request, you also need to create and maintain for at least 4 years records that include all of the following. Documentation to show how you determine the amount of qualified sick leave wages that you paid to the employees. So that would be your forms that you use to get the leave request and approve it, where you say you're approved for X hours of leave between this and this date. And then in addition, the record of what you actually paid them and how you reported that as sick leave and other work that they were paid for during that time period. So your payroll records. You also need to keep documentation to show how you determine the amount of health plan expenses that the employer allocated to the wages. So each pay period, or each time I think it'll be each pay period, each time you do this calculation of the health plan expenses, you need to keep good documentation. And I would recommend putting that into a memo, just saying health plan expenses for this payroll period were determined as follows, and just walk through the calculation that you did. So many employees covered, documentation to support that. COBRA rate, documentation to support that. How many, and then show your work. How many hours we paid this, how many work days we have this month, how many work days this of sick leave or paid emergency family leave this person took, and show your math. Then you also need to keep copies of any completed forms 7200 that you submit to get your accelerated tax credit, and then copies of the completed form 941 that you apply for each quarter of the last 3 quarters of this year in which you pay any of those wages. So let's take an example of the tax credits. Let's assume the employer pays $1,000 in qualified sick and family leave wages in a given period. And so the tax consequence of that $1,000 in qualified sick leave is that the employer does not owe the employer's share of Social Security tax on the $1,000, but it will owe the employer's $1,450 for the employer's share of Medicare tax on that $1,000, which parenthetically it'll get back later. The employer also withholds Social Security, Medicare, and income tax from the employee's portion of those wages, or the employee's portion of those taxes from the wages paid. Let's assume that combined Social Security, Medicare, and income tax is 10% income tax withholding, just for simplicity's sake. So that's $100 that the employer withholds from the $1,000. Then the employer calculates that its qualified health plan expenses allocable to those wages is another $150. And the employer pays another $10,000 in wages to other employees who are not on this kind of leave. And from them, it withholds the employee's share and its share of taxes, Medicare, Social Security, and income taxes. And let's just assume for simplicity's sake that all adds up to $2,000 on those other wages. So how does that all work out? The credit is $1,000 of sick leave wages they paid, plus the $1,450 in Medicare tax the employer paid on those wages, plus the $150 in qualified health plan expenses. So the credit is $1,164.50. And they can apply that against the taxes that they would otherwise be transmitting, which is the $100 withheld against the wages paid to the employee on leave. That's the Social Security, Medicare, and income tax.
the $1,450 that they owe on the employer's portion of Medicare tax on those wages, on the sick leave wages, and the $2,000 that they withheld plus owe on the for Medicare, Social Security, and income tax withholding on the wages they pay to those other employees who are not on sick leave. So they can apply a $1,164.50 credit against the $2,114.50 owed. And so they owe $950 in payroll taxes for that payroll period, and they don't have to pay the rest. So let's look at another tax credit example. This one will be a little bit better for the employer. They're paying now, instead of $1,000 in qualified sick leave wages, they're paying $10,000 in that pay period. And all the rest of this is, well, what they pay the other employees stays the same. So on that $10,000, they don't owe their Social Security tax. The employer doesn't owe Social Security tax, but it will owe $145 for Medicare. And they also withhold the Social Security, Medicare, and income tax from that $10,000 in wages. So we're assuming that was 10%. So they withhold another $1,000 in that. And they calculate the qualified health plan expenses. And now they're, because they've got more people out on this leave, it's $1,500. And they, again, like in the other example, they pay another $10,000 in wages to the employees not on leave, and they withhold or owe a total of $2,000 in Social Security, Medicare, and income tax on those wages. So now how it works out is the credit is now $11,645, which is $10,000 in the wages they paid, $145 Medicare tax they owe, and $1,500 in qualified health plan expenses. And they can apply that credit against $3,145 immediately. And that $3,145 is everything that they withheld from their employees and that they otherwise owe on pay to those employees who are not on sick leave. And so they would submit no payment with their payroll, no tax payment. And after they take their $3,145 credit, they would have a refund claim for $8,500 of the balance. They would have a choice: carry that credit over to the next pay period, or submit the $7,200 and ask for accelerated payment back to the employer of that credit, of that excess. So some miscellaneous points here about how these tax credits work with some of the other things that are going on with the CARES Act. The employee retention credit under the CARES Act, this is the section of the CARES Act that allows businesses that have been partially or fully closed due to COVID-19 to get, or had, I think it's a 50% reduction in their gross receipts. They can get a retention credit for keeping their employees on equal to 50% of the wages that they pay to keep their employees on after March 12th, 2020 and before January 1, 2021, subject to some limits. So if you're looking at your eligibility for those credits, you can receive both those credits and these credits, and in fact, you can claim accelerated payment of the credit of both credits at the same time on the 7200 form. Obviously, you need to meet the requirements of the retention credits, and you can't get the credit for the same wages. So you only get the credit once under one or the other provision. You don't double dip, but it doesn't disqualify you. And here's the other really big one, the Payroll Protection Program loan program under the CARES Act. This is the small business loans for employers under 500, where I'm thinking of it like basically the helicopter money act, where they just are throwing money out of a helicopter to whoever can grab it the quickest. Under that program, you can get, in a nutshell, 2.5 months worth of payroll loans at 1% interest for 2 years, and it's potentially all forgivable if you spend at least 75% of that loan on payroll in the 8 weeks after you get the loan. Can you do that payroll protection loan program and Can you get these tax credits? Yes. But importantly, when you're counting how much payroll you paid under the loan program for meeting that 75% threshold. In other words, at least 75% of the loan has to be spent on payroll as opposed to on interest payments and utilities, and there are some other items that you can get the loan to support, but you can't get so far out of whack that you're spending more than 25% of that loan on things other than payroll. Well, when you're calculating how much did I pay in payroll for purpose of the payroll protection program, the payroll cost does not include the tax credits that you receive for qualified leave wages. So you're going to have to consider that when you're projecting out how much of a loan to apply for. If you're in that mode now, you might have to do some fancy calculations, and you don't want to reach so far on getting the loan that you are not able to meet that 75% threshold, because that'll limit your ability to get loan forgiveness. At least that's what it appears like now. So with that, I think we are done. On to the questions. If you have any questions, now would be a good time to put them into the question box. I'll see if I can answer them. And if there are no questions, then you are free to leave.